Hey there, my name is Kevin Carlson. I'm a mortgage broker here in Canada. So a little bit of changes recently when it comes to insured mortgages. Now what an insured mortgage is when you're purchasing a home with less than 20% down, then you have to have those default mortgage insurance premiums, typically called CMHC fees. So just earlier this year, back in July, they announced that they were going to allow people buying a brand new home to get an insured mortgage, so less than 20% down, to get a 30-year amortization. So that was a little bit of welcome news. They've just changed it a little bit more just recently, that they're going to be expanding that to all first-time home buyers, allowing them also to get an insured mortgage stretch over 30 years. And another change that was announced as well is that the insurable mortgage purchase price was going from $1 million up to $1.5 million. So that's really welcome for people looking to buy a home in larger markets that have higher purchase prices. So Vancouver area and the GTA, very much welcome news. These new rules and guidelines will be coming in, it sounds like, December the 15th. So they're hopefully this is going to bring a bit of relief for those people looking to get pre-approved. So let's look and see what that really means. So how much more of a mortgage can you get pre-approved for if you stretch your amortization out that extra 5 years? So I'm just going to go over some numbers and just show you the difference on what my typical first-time home buyers look like. So what I'm going to be using here is a gross household annual income of $130,000. So that's combined income. If it's a couple buying, making $60,000, $65,000 a year gross, combined to be $130,000, these numbers kind of fit with that. So they have to have good credit, but no ongoing debts with car loans, credit cards, lines of credit, that sort of thing. But like I said, good credit. I'm going to be using the minimum down payment, so 5% down, but once you get over $500,000, it changes a little bit. So you're allowed to do 5% on the first $500,000, and then you have to put 10% down on the difference, on the extra. So we're going to be looking at this, so that $130,000, so today an insured mortgage with that 5% down, they would be pre-approved for a purchase price of about $556,000. After the December 15th, after those new rules come in, we can stretch that out to 30 years, and those same clients would be pre-approved for a purchase price of about $585,000. Keep in mind though that default mortgage insurance is a little bit higher, 0.2% higher, so brings the insurance costs on that mortgage up about $1,100. So that certainly helps a little bit, allows people to get a little bit of extra purchase price, but there's some caveats here. What is the real cost of getting this mortgage? Let's go over some of those numbers and you'll be shocked. So let's do an interest cost comparison using that $585,000 purchase price. So what I'm going to be doing here is not something I typically do, is I'm going to take that same mortgage and stretch the same interest rate over the full 25 years, just so it's easier to compare apples to apples. So 25-year mortgage versus a 30-year mortgage at the same rate. So the total interest cost for that mortgage over 25 years at the same rate is $382,618.91. Now, fasten your seatbelts. That same mortgage over 30 years, if they don't do anything extra, don't make lump sum payments or anything else, the total interest cost on that mortgage over 30 years is $473,270.97. Like a complete shocker. And the difference being $90,652.06. I actually ran these numbers twice. I was completely shocked to see that sort of a difference. I don't typically run 25 and 30-year amortization mortgages, and so I was completely shocked to see what this true cost of a 30-year mortgage is. The best way I can recommend, and I do for every single one of my mortgage clients, is take advantage of those prepayment privileges built into your mortgage. So some of the things that you're allowed to do is to increase your payments, usually by up to 15% each year. You're also allowed to do lump sum payments to the principal of another 15, sometimes 20% per year, and some lenders even allow you to do unlimited double payments. These are the best way to ensure that if you got a 30-year amortization mortgage, that you reduce that back down to at least that 25, if not 20-year amortization, so you're not paying that extra $90,000+ in interest by the time you pay that house off. So I hope these numbers help you. If you're looking to get pre-approved to purchase a house in Saskatchewan, please feel free to reach out to me. It would be my pleasure to help you. Thanks for your time.